A first look. Risk parameters in the crypto arena. The world of cryptocurrency trading is exciting. It offers new opportunities for investors. However, this world also comes with unique risks. These are not like the risks in traditional finance. Understanding these risks is the very first step. It is essential before you even think about trading. Many people jump in without this understanding. They often face difficulties because of it. Cryptocurrency exchanges are the marketplaces for these digital assets. They are central to how most people interact with crypto. These platforms must manage the inherent risks effectively. They do this by setting up specific rules and limits. These are broadly known as risk parameters. These parameters are not arbitrary. They are carefully designed systems. Their purpose is to protect both the exchange and its users. Without them, the crypto market could become far more chaotic. The nature of risk in the crypto space is constantly changing. New technologies emerge rapidly. Market sentiment can shift dramatically in short periods. Therefore, risk parameters cannot be static. This dynamic approach is vital for maintaining a stable trading environment. The building blocks, defining risk parameters and their crucial role. So what exactly are risk parameters in the context of a crypto exchange? Think of them as a set of predefined rules, thresholds, and automated controls. These are implemented by the exchange's systems. They govern how trading activities are conducted on the platform. Examples include margin requirements for leveraged trading. They also include withdrawal limits to prevent illicit fund movements. Order size limits are another common parameter. Liquidation protocols are also a critical part of this framework. Each parameter serves a specific purpose in managing potential dangers. The significance of these parameters cannot be overstated. They are the bedrock of an exchange's operational integrity. For the exchange itself, robust risk parameters prevent catastrophic losses. They ensure the platform can meet its financial obligations. This is especially true during extreme market volatility. If an exchange becomes insolvent, it affects all its users. Therefore, these parameters are a primary line of defense. They maintain the exchange's solvency and trustworthiness. This stability is crucial for the long-term viability of any trading platform. Beyond protecting the exchange, risk parameters are vital for user protection. Navigating the storm key risks inherent in cryptocurrency trading. One of the most prominent risks in cryptocurrency trading is market volatility. Crypto prices can experience dramatic swings in very short time frames. Bitcoin, Ethereum, and especially smaller altcoins can rise or fall by significant percentages within hours or even minutes. This high volatility presents opportunities for profit. However, it equally presents substantial risks of rapid and large losses. Understanding this inherent price instability is crucial. Traders must be prepared for sudden market movements. They need strategies to cope with such fluctuations without panicking or making rash decisions. Security risks are another major concern in the crypto space. Exchanges, holding vast amounts of digital assets, are prime targets for hackers. A successful breach can lead to the theft of user funds. While reputable exchanges invest heavily in security measures, the threat remains persistent. Beyond exchange hacks, individual users also face security risks. These include phishing scams designed to steal login credentials. Maintaining strong personal security practices is therefore just as important as relying on the exchange's security infrastructure for protection. Liquidity risk is also a significant factor to consider. Section 4, the exchange's shield. How platforms manage user risk. Cryptocurrency exchanges employ sophisticated methods to manage trading risks and protect users. One common tool is an insurance fund, built from trading fees. It covers losses if a user's position is liquidated below their bankruptcy price. This ensures the platform remains solvent during extreme market events. Margin requirements and automated margin calls are key for leveraged trading. Exchanges set minimum margin levels to maintain leveraged positions. Beyond trading risks, exchanges invest heavily in security measures. This includes storing most cryptocurrency assets in cold storage. Section 5, your personal toolkit. Practical strategies for investor risk management. While exchanges implement broad risk management systems, individual investors must also take personal responsibility for managing their own risk. Diversification is key. Spread investments across different assets to reduce risk. This helps smooth out portfolio volatility and protect against catastrophic loss. Use stop-loss and take-profit orders to manage risk and enforce discipline. Start small and only invest what you can afford to lose. Continuous learning is crucial in the evolving crypto landscape. Section 6. The Foundation of Success. Why understanding risk parameters is non-negotiable. Understanding risk parameters is crucial for sustainable success in cryptocurrency trading. They act as invisible guardrails, ensuring smooth and safe trading. Ignoring them is like driving without knowing the rules. This knowledge empowers traders to manage exposure and interpret market signals. It leads to informed, rational decisions, stripping away emotional responses. Mastering risk is the cornerstone of enduring success in the cryptocurrency market.